Trust Retirement Plan Services, we stress that understanding the basics of investing is imperative to your financial future. This is why we appreciate you taking the time to participate in the presentation on Investing 101. When investing in your retirement plan, we want you to understand the difference between saving and investing. We want you to understand the basic investment categories, what a mutual fund is, what the different asset classes are, and what target date funds are. Once you understand these topics, you'll be equipped to invest competently for retirement. So let's get started. When you save, you're generally working towards a short-term financial goal. This money may be in your savings account, a CD, or a savings bond. Your rate of return may not be great, but it is predictable and typically easily accessible. Investing, on the other hand, is usually tied to long-term goals like retirement. By taking on more risk, you expect a higher rate of return for your money when you're investing. The value of your original investment could fluctuate and no return is guaranteed. Even if you consider yourself a conservative investor or are unsure of the market during challenging times, it's hard to imagine that you can achieve your long-term goals without investing. History indicates that investing in the stock and bond markets provides greater returns than investors can earn through guaranteed savings. Next, let's look at some of the common investment options in Union Bank and Trust retirement plans. In most retirement plans, you will have three main options to invest in: stocks, bonds, and cash investments. Many of you have cash investments, or types of cash investments. They are perfect for emergency funds, saving up for an upcoming purchase, or for dollars that require capital preservation. This is because these types of investments are considered liquid, meaning if you needed them, you'd be able to access them rather quickly versus the other investment options. Typical cash investment options would be a savings account, money market, CDs or certificates of deposit with less than 12-month time frame. Between stocks, bonds, and cash investments, these liquid investment options are typically considered the most conservative. Fixed income securities are investments that provide a return in the form of fixed periodic payments and the eventual return of the invested principal at maturity. With bonds, you're in essence loaning your money out to either a corporation or a government entity. In return, they typically pay you interest payments as they return your money at the maturity of the bond. Bond funds, on the other hand, are like a grouping of various bonds that have different maturities, so bonds are constantly coming into the fund and expiring out of the fund. Fixed income investments are typically considered more aggressive than cash investments, but more conservative than stocks. If you would rather own than loan, then equities may be appealing. Equities are considered to have the most risk out of our three options because when buying an equity, you're buying ownership in an individual company or multiple companies through a stock mutual fund. With these types of investments, you as the investor will then experience the ups and downs of that company that you're invested in within the market. Many different variables affect the stock's performance within the market on a daily basis, such as recent earnings of the company, economic factors, and investor sentiment, just to name a few. To reiterate the risk levels of our three main categories, this pyramid shows that stocks are thought to have the most risk versus bonds and cash investments. However, with the most risk, you can also expect to potentially have the most amount of return over a long period of time from stocks. Whereas with the money market, it typically will have the least amount of return, but it will also be the most conservative option as well. Now that we understand what a stock, bond, and cash investment is, we can look at how these are incorporated into a mutual fund. So what is a mutual fund? Mutual funds provide diversification by investing in hundreds to thousands of stocks or bonds. Every fund has a very specific investment objective, and you can further diversify by using a variety of mutual funds. Each mutual fund is also managed by its own professional fund manager. So far we've covered stocks, bonds, cash investments or money markets, and mutual funds. Now we can look at the various asset classes an investor will typically be able to invest in within their retirement plan. At this point, you might be thinking to yourself, what are asset classes? Asset classes are different types of options that you as the investor can invest in a typical retirement plan offered by Union Bank and Trust. You will have the option of investing in a money market mutual fund, which will typically be our most conservative option. Next, you will also have available various bond funds to choose from. Subcategories of bond funds you might have available would be short-term funds, A short-term bond fund invests in debt securities with a maturity time frame of less than 5 years to provide moderate interest income, low principal risk, and liquidity. Intermediate-term bonds invest in debt securities with maturities generally between 5 to 10 years to provide moderate interest income, moderate principal risk, and liquidity again. These are considered to have a little bit more risk than short-term bond funds. A third bond option a retirement plan participant might have is a Treasury inflation protected security, also commonly referred to as a TIPS fund. TIPS funds invest in Treasury securities that are indexed to inflation in order to protect investors from the negative effects of inflation. TIPS are considered a low-risk investment option since they are backed by the U.S. government. The remaining portion of the page is devoted to stock mutual funds. Large cap funds invest in stock of large, well-established, mainly U.S.-based companies with market capitalization of greater than $10 billion. Next, we have mid-cap stock funds, which invest in the stock of medium-sized companies, mainly within the U.S. Again, they typically have market capitalization between $2 billion and $10 billion. Small-cap stock funds invest in the stock of small-sized companies, mainly within the U.S. as well. These typically also have market capitalizations under $2 billion. Finally, international stock funds invest in the stock of companies that reside outside the United States. Similar to the pyramid chart showing levels of risk, this is also set up to illustrate how the asset classes move from conservative-oriented to more aggressive investment options. The final three categories represent styles of investing. Mutual funds that utilize the value method of investing choose companies that possess a lower stock price in relation to its annual earnings, and in many cases, the stock will pay a dividend. Mutual funds that employ a blend strategy invest in companies that represent the entire market in each class. This is more of a general approach to investing in various companies. Finally, growth mutual funds invest in companies that possess a higher rate of earnings growth that may increase the volatility of the stock. When investing in a retirement plan provided by Union Bank and Trust, investors can choose to manage their own funds by selecting individual mutual funds from these asset classes. Many times, however, investors have another option for investing within their retirement plan. This last option is called target date funds. So why would an investor choose a target date fund, and what is a target date fund? With target date funds, everything is basically already done for the investor. Target date funds offer the power of a diversified mix of mutual funds in one single fund, with the added benefit of professional management. So how do these funds work for you as the investor? Well, they take care of your asset allocation, meaning investors don't pick and choose mutual funds because these funds were created based on your time until retirement. The final benefit is that these funds automatically rebalance over time. They are more aggressive when there is more time until retirement, but as you move closer to retirement, the funds shift its allocation to be more conservative. Here you can see the year in the name of the fund represents an investor's year of expected retirement. For example, normal retirement age would be 67 if you're 30 years old. Therefore, you would have 37 years until retirement. You would fall closest to the target date 2050 fund. Along with knowing the necessary fund to invest in, it is also important to know what the asset allocation of each fund is. With the target date funds, the further out from retirement, the more aggressive the fund will be allocated. Take, for instance, the 2050 fund. For an investor retiring in or around the year 2050, at this point in time they will have the majority of their money invested in U.S. and international stocks, as well as a smaller percentage invested in bonds. As mentioned before, these target date funds automatically rebalance the investments with each fund to move progressively more conservative throughout the years. This means that in 10 years, the 2030 fund will be invested like the 2020 fund is right now. Then, 10 years from that, people in the 2030 fund should be retiring or close to retirement, so their investment allocation will now look like the 2010 fund, with less than half of their investments in stock funds, and now the majority of their money will be allocated to bond funds and money market to be more conservative and focused on capital preservation as the investor starts to withdraw money to live on for their retirement years. Understanding the basics of investing is imperative to successful investing within a retirement plan. The next step is to understand what asset allocation and diversification are and how they play an integral part of investing within a retirement plan. To view videos on these topics, please visit www.ubtrust.com/education. The videos for asset allocation and diversification are located under the media section of the website, as well as many other useful resources. This concludes our presentation on understanding basic investing. If you have any questions or concerns, please feel free to contact a member of our financial education team at 402-323-1592 or toll free at 1-888-769-2362. Thank you very much for attending, and we'll see you next time.